Hello and welcome to Moneycontrol. You have tuned into IPO Watch and I'm your host Nickey Mirchandani. The initial public offering of Medi Assist Healthcare services of around 1,172 crore has opened for subscription on Jan 15. That's today. The issue is purely an OFS of 2.8 crore shares, mainly from the promoters. Post-listing, the equity share of the promoter and the group will come down to 45% from 77% earlier. But to know more about the company dynamics, the structure, outlook and the strategy, we're being joined by Dr. Vikram Jit Singh Chhatwal, Chairman and the whole-time Director, and Mr. Satish Gidugu, who is the Chief Executive Officer and the whole-time Director of the company. Hello there. Straight up, I'm going to ask, let's start off with the basics. So tell me more about the company, the industry that you function in, the scalability of this business, and whether or not you'd be able to outperform the industry.
Thank you. First of all, wishing all of you and the viewers a happy Sankranti, Bihu and Pongal. Medi Assist is a third-party insurance administrator. We work only in the health insurance space. We're a very India-focused, India-centric business. And we work with our insurer partners, of which we have 27 today on the group side and 12 on the retail side that we work with. Clearly, I think the best way to understand this industry is given the fact that India is underpenetrated from an insurance perspective. About 16% of our population has health insurance cover today, and those tailwinds are expected to continue to grow, given the fact that India on its centenary in 2047 talks about health insurance for all. From a Medi Assist perspective, I think we've been focused on the group side. We've been focused on working with enterprise or employers, and increasingly have increased our footprint of working with retail policyholders. As a service, we deliver all of the service elements that are covered under a health insurance plan, which essentially means consumption of both inpatient and outpatient healthcare services under a policy.
Sure. Let's talk about, I think I bunched up a lot of questions at the first go, so I'm just going to go one by one. Tell us more about the industry that you operate in, the scalability of that industry. What has your market share been in that industry? Because you have the first mover advantage. I don't see any listed entity within this space right now. So clearly the first mover advantage creeps in here. But what's the rate at which the industry is expected to grow in the next 3 to 5 years, vis-a-vis what kind of market share you have presently, how much is that scalable, and what is the growth that you are looking to grow at when it comes to the top line performance?
Good. Satish, do you want to?
Sure. So, like Dr. Vikram said, bulk of our work is as a third-party administrator in the Indian health insurance market. In health insurance has 3 segments: group, retail, and government, and we participate in all of them. Within the group health premiums at the industry level, we service over 30%. And within the retail, we have about 7-8%, that we manage, and we have a selective presence in the government business segment. All in all, giving us about a 20% of India's health insurance premiums as a market share from a servicing perspective. And that's been steadily growing over the last few years, and predominantly organic, in fact, for the last 5 years. Now we've also acquired 2 other TPAs in the process of consolidating and giving us almost 20% of the market share. In the last 3 years, we've grown faster than market, both in group and retail individually, and taken market share, given our high retention rates and ability to add new accounts. And we hope to continue to deliver at that level.
Did I not capture the industry growth rate at what you expected to grow in the next 3 to 5 years?
Industry historically grown between 19-20% year on year from a premiums perspective. We've grown slightly faster than industry.
Which is how much?
About 24-25%.
That's the CAGR of the last 3 years when it comes to the premium. So what is the expectation for the industry going forward?
We expect the industry to continue to grow at about 23-24%.
So the pace that you're capturing right now will be the pace at which industry will grow?
Yes.
So do you expect to outperform the industry growth in that case?
I think historically we've done it well enough, and we
are you confident enough to kind of outperform the industry going forward too? What kind of market share are you looking at?
Market share is not specifically a target, but if you look at from I think things that drive the market share is the service level, because the policyholders can choose us, once a year. Right. They can change us, And yet, from a group perspective, we've always had a 94+% retention rates, and which is fairly high. And retail, we've been continuously adding newer insurers on our retail portfolio, and we hope to continue to add more.
Okay, so that gives some sense of direction there in terms of the outperformance coming through. What's your market share right now?
20% by premiums in group and retail.
Okay, and you expect that to go by 40, 44, 45% by when?
Well, not by 45%. I think the market's accreting at about 23, 24%, and we hope that we can match that number as we go ahead.
So that's the market share that you're looking at?
Well, the 20% will, that's our market share today. The industry is growing at about 24%.
That's exactly what I was trying to understand. What's the kind of market share you're trying to have?
I don't really have a perspective. I think for us, what's to continue to strengthen and deepen our relationship with insurers, strengthen and deepen our relationships with networks of hospitals that we build.
Sure. I mean, I'm not looking at a very near-term objective or a near-term target, sir. I'm looking at a picture which is slightly drawn out, which is a 3 or a 5 year projection that I'm looking at, so that there is some sense of understanding of how much scalable this business is, how much growth can come in terms of the top line, just to understand the scope of the penetration of the business.
Yeah. Well, so I think if the market's accreting at 23, 24%, I would hope as a business we at least get close to that in terms of our growth on the base that we have. Many factors influencing that market growth. Penetration, of course, consumption of benefits, inpatient and outpatient, and of course, just the Government of India's participation, which I think is key to the way we think of health insurance for a nation.
Okay, so you've pretty much drawn out 3 parameters as to how do you expect the industry tailwinds to essentially stack up. That is the consumption pattern, that's one. The penetration is the second bit. India Inc. globally also is what you'd want to talk about, and the outpatient scenario where, earlier we had a scenario where you had to be hospitalized for 24 hours in order to avail the benefits, but now incrementally the trend is changing, and even outpatients, when they're going for visits or buying medicines, perhaps they can get the services for which you provide admin services or the outsourcing of these services.
Correct.
So tell us more about the tailwinds per se just for the company. You've highlighted it for the industry. Why don't you highlight it for the company right now?
I think in many ways what we do mimics the tailwinds for the industry. The industry is going through a sea change in terms of just sheer scale and size of penetration and adoption of health insurance in India. Second, alongside adoption is the complexity of products, the inpatient and outpatient conversation that you and I have been having. The last of all of that is all of this will create a new ecosystem of consumption. It'll be a lot more intense than it has been historically, which was only inpatient. All of this put together, I think here's an industry that is in many ways set for a secular growth trend, and I think for both the insurers and TPAs alike, this is going to be something that Medi Assist will match and follow. On the global side, we think India is going to increasingly globalize. India Inc. is going to become part of a global economy. And as more Indians travel abroad, I think what we have been able to do and focus on is solving for Indians and their healthcare needs across the world. Today, we have networks of hospitals not only in India, which is the dominant base of our business, but across 141 countries around the world where Indians travel for work. And so really it's going to be a mix of these two capabilities that Medi Assist continues to bring back to our insurance partners, continues to bring back to our hospital networks, and continues to bring back in service of the policyholder.
Okay, I have 2 follow-up questions there, and essentially a very big question that is coming your way is why invest in a proxy or an alternative play for health insurance industries where one can directly invest in the health insurance stocks? You have Star Health, ICICI Lombard. So what is essentially the driving factor where one can look at just the books of this company?
Yeah, first of all, a great question, because I think we're not necessarily a proxy. We are a partner to the health insurance ecosystem, and we're a partner to the consumption and delivery of healthcare services that are covered under a health insurance plan. And while we mimic the way health insurers will continue their business and their penetration in India, in many ways we also are the bellwether definition of what's going to actually happen as experience of policyholders when they consume a benefit. And so really, I think this is a partner industry and not necessarily an outsourced service arm that in many ways does not stand on its own. Globally, TPAs have a very clear market definition. TPAs are the dominant players in the administrative services related to health insurance, and I would hope that India, at least directionally, historically, what we've seen is that India continues to adopt and partner with TPAs increasingly as a percentage of the total premiums that are sold and administered in our country.
How much is the premium right now here versus globally, and also the penetration of health insurance here versus globally?
Very fair. India is underpenetrated. About 16% of our population has health insurance. That is expected to double by 2028.
Abysmal number, even if you look at it.
That is correct. But a huge number when it comes to growth. Second, TPAs as a share of total premiums sold in terms of administrative services, about 55% of total premiums that are collected every year by insurance companies are administered in partnership with the third-party administrator. And that again is expected to continue to grow with a share of premiums administered by TPAs touching about 61% of total premiums by 2028.
Okay, that's a huge exponential scaling up that we're looking at least on the paper. How much of that is executable remains a question, of course, in everybody's mind. But on the face of it, it looks like very scalable business. But the only concern that I could also pick up is, the concentrations of revenue essentially coming in from the largest client, which contribute to 71% in FY21, which the number has come down substantially. I mean, it's come down to 71%. But how do you expect that to evolve by the next 1 year or so, for that matter?
See, I think the concentration we'll have to look at by the segment from a group, retail and government perspective, and we reasonably mimic how the industry dynamics are changing from who's taking the lead in the market share. Of course, in group, some of the larger clients have stayed with the same insurance companies for many years. So, but I think we reasonably represent the industry dynamics on the group, and also given that we work with 27 out of the 28 insurance companies. The risk of losing a client is very low, and that shows in our 94+% retention rates as we speak. Retail, in fact, we've been adding more and more insurers. It's not at a policyholder level. In fact, 50% of our retail is nearly from the private insurers that we service, and 50% is from the public sector insurers. And that's a number that's continuing to grow. So this concentration moving is more, how the market is evolving, and not a cause for concern at this point.
Point well taken. Let's also understand about the business structure in that case, Mr. Satish. Do you intend to simplify the business a little more? Because I could just see, because the number of inorganic expansion that the company had, it was too many entries at that point. You were looking at direct entities, and within that you had indirect subsidiaries. Would you want to at some point simplify the structure, merge, consolidate, and if that is the plan, by when this will be completely executable? And what will be the synergies too from the merger as and when they come through?
Understand. So the holding company, Medi Assist Healthcare Services, is the one that's listing right now. I think of us as two large businesses. One is a domestic TPA business led by Medi Assist TPA, where we've acquired two other TPAs that are already in the process of amalgamation. Historically, we've seen about a year or so for the amalgamation to complete, and we will have one single TPA entity that will provide TPA services in India. Outside India, we have Mayfair, UK. Okay. And that will remain the only international, arm at this point in time. So I think that's the simplification, and the rest is just a due procedure for amalgamation of companies right now.
Okay, so Medi Assist Insurance TPA Private will be the one subsidiary, and Mayfair will be the second one, of course, which will house in the other subsidiaries. And this will be the merger will be effective in what kind of time frame? In
flight, we expect about less than a year to.
And what will be the synergies of the mergers on the financials of the company?
So we expect to hold back to our original margin profiles, because you've seen that much of the industry currently operates at a lower margin profile, today, which we've acquired with consolidating. So post consolidation, we don't expect any further impact on the margins.
But how about your bottom line in terms of the financial tax implications, in terms of the other entries that we're looking at, any kind of savings that will come through on account of the merger of the entities? I'm sure there will be some synergies that will also kick in after the merger, right?
We absolutely hope so, and then that's the business case. But if you look at some of the things that we do differently from the rest of the industry, like our employee benefits costs are just about 40% of our total revenues, right? We have significant deployment of technology. So many of the acquisitions in India, we move them to our technology platform, our operating framework. So clearly we expect that to flow through.
Let's also touch upon something that you spoke just now, your EBITDA margins, right? They've been almost double of what the industry is working with, at least the last 2 to 3 years that we've checked. Most of the companies, of course, operate in an unlisted space. So, but 6 to 12% is what I could figure out, the range of unlisted peers versus 23%, 20 to 23% that the company has delivered in the last 3 years or so. Help us understand the reason why the company has managed to outperform in terms of margins, and B, do you think this outperformance will continue, because we're seeing a 16% margin profile in the first half of the financial year? So how do you expect that to stack up?
So just to clarify from the first half, and then I'll come back to your original question.
All right.
So historically, last 3 previous years, the EBITDA margins have been between 23 and 24%. And first half, we are closer to a 21%. And it is more on account of one-time expenses and acquisition costs and the synergies that are still in flight. And that's a temporary situation. And
sorry, I didn't catch the reason you said. The reason
the more we had the some one-time expenses in H1, and the acquisition costs of all the acquisitions that have gone into the P&L, and of course the synergies are being built, with the businesses that we are doing. And from a PAT margins perspective, we've historically been between 14-15%. Even in H1, we've actually generated 45 crores of business, PATs. There is an accounting entry on account of an exceptional item from selling shareholders that's passing through the P&L with no impact to the company. As a result, the reported EBITDA is lower by 21 crores, but the business PAT that we generated, the adjusted PAT, is about 45 crores, and it's well explained in the RHP.
Okay, that was exactly my next question, which you pretty much preempted, because we were looking at a profitability of around 60 plus crore in the last 2 years, and this year it was 22 crore. Of course, it's also because of the exceptional item that you just indicated. But do you think in terms of profitability too, we'd be able to outperform the number? Because 45 crore is what you've registered in the first half. If the numbers were to be analyzed, can we look at a number of 90 crore? Or usually, how is the first half better than the second half? Can you help us understand the seasonality of your business per se, if I'm supposed to?
Given the reasonably disproportionate market share we have, the seasonality aspect is not the biggest portion of our life. But given our revenue recognition models, and given that we are a continuously growing business, each quarter tends to be slightly bigger than the previous quarter. So second half is marginally higher than first half from a business perspective.
Okay. Another one which I want to pick up is the show cause notices from IRDA. For Medi Assist TPA, Raksha TPA and Medvantage TPA, how serious are these in nature? Have they been already taken care of? What is the financial implications? Because usually in the markets we're also looking at some amount of notices being sent out to perhaps accounting for Polycab, and we've seen the stock really not doing well in response to that. So how serious are these notices when it comes to your business?
So every regulator has an inspection routine of the regulated entities. So we have regular inspections by the regulator. And these observations we've fully disclosed, 100% disclosed in the RHPs. There are no financial implications. All of them have been addressed and resolved and acted upon. These are historical. And at this point, there is nothing that is not already in the RHP.
Okay, so they've already been taken care of. There is no financial implications, and it's a shut case in that way. We're looking at for all the notices that have been shared to the subsidiaries.
Yes, it's part of the regular inspection process. It's not necessarily a notice, from that perspective.
Okay, point well taken. Okay, standard disclosures there, just the part of the business, how we look at it. But just to understand, what are your plans of growth now going forward? Because there are a bunch of companies that you have acquired in the past. How does the company now intend to grow? Is it going to be organically? Is it going to be inorganically? If inorganically, what is the kind of funds that the company will need? Would it raise debt, or would it be met through internal accruals? All of it.
So we've been a debt-free company all our life.
Okay.
In entire our history, we've never raised debt. We have funded all of our acquisitions through internal accruals. Right? Even in the past, M&A has not been a driver for top line. It's been a very selective, approach to M&As, either in terms of accelerating relationships, which we didn't have in the past, acquired those relationships, or specific geographic areas where we didn't have a lot of presence or the retail presence. It's been very selective, from that perspective. So we'll continue to be acquisitive but selective in that process. So our growth is predominantly how we think about is organic.
Okay, so the inorganic companies is not, you intend to grow inorganically, but at this
Being
point of
selective,
time, it's going to be a little less than what we've seen in the past, right? I mean, the company has come to a substantial size now. So would you want to slow it down and consolidate this? How is the strategy going to look like going ahead?
M&A has nothing to do with the size or wanting to get to a certain size. Like I said, we've been very selective in terms of the capabilities we wanted.
So in this year,
Right.
is there anything else which is lined up?
Nothing that's already not all in the RHP, and we'll continue to keep looking for opportunities. If we find something good, you will see us do something.
All right, point well taken. Talk about your financials last that I have in my mind. It's about the net cash flow inflows entry that we're looking at. Cash flow from operating activities, and the first half of the financial year was a little bit negative. Would you want to explain that?
We've paid for the acquisitions, and from our own cash flows, we still have a nearly 145 crores of cash balance as of September 30th, and we've paid dividends for the last 3 years consistently.
All right, gentlemen, this is all that I need to ask to you, at least. If there is anything else that you'd want to highlight, well, it's an open ground there. Would you want to perhaps?
No, I think thank you so much, but it's been a journey for us as a team that we have today arrived here and are sharing our business story as the first in a segment that India has not seen as a listed entity. And I think, I hope that we continue this partnership and showcase the relevance and the role of TPAs in the overall furtherance of health insurance and penetration in India.
All right, gentlemen, we're just going to leave it at that. And thank you so much for taking out the time and having this conversation in the
Thank you
studio
so much.
here. Well, that
Thank you.
was the management of the company, but that's all that we have in this edition of the show. Thank you so much for tuning in.